Divorcing business owners have special needs that may set them apart from other couples. When business owners get divorced, their settlement may have profound consequences on the business and its other owners. Often, one spouse sells or gives up a share of the business to the other spouse. Since divorcing business owners might not have cash on hand to pay a lump sum buyout, they might have to make installment payments over months or years. It is critical to structure the divorce settlement properly with documents that will minimize tax consequences, quantify and secure the payments to be made to the spouse who is leaving the business, and preserve the company's ability to operate and obtain financing. These are the top 5 documents that a divorcing business owner must have when finalizing a settlement. First is the marital settlement agreement. Divorce courts rarely issue orders containing sufficient detail to adequately protect divorcing business owners. Settlement provides the best opportunity to resolve important financial and tax issues that a divorce court might overlook. A settlement agreement should contain a clear description of the stock, partnership, or LLC membership units and other business interests being sold or waived, how much is being paid, when it is being paid, and what happens if the payments are not made in full and on time. Unincorporated associations are tricky because their assets and liabilities are often intertwined with the owner's personal assets and liabilities, so be as clear as possible. When setting the price, the business owner must consider whether the price is consistent with the value reported to tax authorities for estate planning purposes. The spouse who is making payments might be required to maintain enough life insurance, retirement assets, or investments to pay off the obligation in full upon the death or default. The other documents related to the sale of the business can be attached to the marital settlement agreement and signed at the same time. The second document would be an installment note. The installment note states the price that the business owner must pay for the spouse's share of the business, the timing and amount of each installment payment, and the consequences for late payments or default. If the payments will be made over a period of years, the note might include interest, including interest for late payments. An acceleration clause might make the entire balance due immediately upon the sale of the business, death, bankruptcy, or other major event. In some jurisdictions, a confession of judgment clause might avoid the delay and expense of a collection lawsuit if there's a default. The majority owner might be required to provide a personal guarantee. The note can also be secured with a mortgage against real estate or a lien on business assets, such as equipment or receivables. Number 3 would be the mortgage or security agreement. An installment note can be secured by a mortgage against real estate or a lien on business assets, such as equipment or receivables. The lien against business assets can be recorded publicly by filing a UCC-1. In some cases, the business might want to subordinate the mortgage or security agreement so that trade creditors and lenders who will demand higher priority will not withdraw their credit. Fourth document is a pledge of stock. A pledge agreement creates a lien on the stock of the business. The pledge agreement might contain representations and warranties about the financial condition of the business or give the selling spouse a right to vote the pledged stock or inspect the books until paid off. If dividends or distributions are paid, the pledge agreement might direct the proceeds to be paid toward the loan. The pledge can also restrict the sale, gifting, or dilution of the stock. Finally, a consent and waiver. If the business owners have previously signed a buy-sell agreement or right of first refusal giving the company or other owners a right to buy their shares, then they should probably obtain the consent of those other owners before transferring stock between themselves. A consent and waiver confirms that the company and other owners will not exercise their rights when divorcing spouses transfer their stock. For family law help in Western Pennsylvania, call me. I'm Brian Virts, and for more than 25 years, I've represented business owners and entrepreneurs. I've represented all kinds of people with complicated child support and divorce issues. My law firm is a powerful team of lawyers dedicated to family law. In Pittsburgh and Western Pennsylvania, call me at 412-471-9000.